So the number of the week is $200 billion.
Which is, that's a number that usually belongs to a country's GDP, not a company's shopping list.
Exactly. But that is the world we're in as of February. Amazon is guiding for, well, pretty much $200 billion in capital expenditures for 2026.
And Alphabet is right there with them. What is it, 175 to 185 billion?
Right. So just for context, you're talking about two companies spending nearly $400 billion in 1 year, just on infrastructure.
It's the Capex shock. I mean, that's really the only way you can describe it. And normally, when a company announces they're investing in growth, the market cheers.
Oh, yeah, they love it. But this time,
the market absolutely hated it.
Hated it might be an understatement. Amazon beat on revenue. Their cloud division, AWS, was up 24%, which is just massive for a business that size.
Huge.
And yet the stock just plummeted, more than 10% after hours. It feels like investors are looking at this bill and asking, is this an arms race, or are you guys just setting money on fire?
Well, that's the trillion-dollar question, isn't it? But I think if you only frame it as spending, you miss the bigger story here. We aren't just seeing a construction boom for server farms.
What are we seeing then?
We are watching the beginning of what I would call the Great Displacement. This money, this capital, it isn't going to maintain the old way of doing things. It's going toward building a brand new economic engine that honestly threatens to delete the old one.
And that threat is becoming really, really specific. I mean, we have to talk about the sauce rot.
Yes.
That was the other massive story this week. While the hardware guys like Amazon and Google are spending, the software sellers, your Salesforce, ServiceNow, LegalZoom, Thomson Reuters, their stocks are just getting hammered.
And this is where it all gets very real. For the last, 15 years, the software as a service model has been the holy grail of business.
Build it once, sell it a million times.
Exactly. You build a platform, then you sell seats. A law firm has 100 lawyers, they buy 100 subscriptions. It's predictable. It's recurring revenue.
The per-seat model. It's how that entire industry is valued. But the thesis that's taking over this week is that AI just completely destroys the value of the seat.
It does. If I can spin up an AI agent or a multi-agent team, to use the new buzzword, to do legal research or handle customer service tickets, I don't need 100 humans logging into Salesforce anymore.
I might only need 5.
Precisely. And if you don't need the humans, you don't need the subscriptions. The market is just terrifyingly efficient at pricing this in. Investors are realizing that AI isn't just a feature you add to software. It's a force that might replace the software entirely.
Or at least it replaces the billing model. It's not about the seat anymore. It's about the outcome.
Right. Why pay for the tool when you can just pay for the finished product?
And we're not talking theory anymore. We have to talk about the vibe coding incident. This was the moment that abstract fear became very, very real.
This was just fascinating. So Anthropic, they released their new model, Claude Opus 4.6. And it has a 1 million token context window. Now, just to clarify for everyone, the context window is basically the AI's short-term memory. It's how much information it can hold in its head at once.
And 1 million tokens is? What's equal?
It's roughly a stack of books, a very big stack of books.
So it can handle these huge, complex projects without forgetting what it was doing 5 minutes ago.
Exactly. So CNBC decides to test this out. They take an anchor who was definitely not a software engineer.
Right.
They give him this tool, and they ask him to replicate Monday.com. Now, Monday.com is a massive project management platform. It's a public company. It took years of engineering, millions of dollars to build.
And the anchor built a working replica of the core features in under an hour.
Less than 60 minutes.
That is the aha moment.
Yeah.
I watched the demo, and it wasn't just, writing a little bit of code. It was building the interface, the database connections, the logic, everything.
It's this idea of vibe coding. You just prompt the AI based on how you want the app to feel and function.
And out comes a multi-million-dollar product. The moat for these legacy software companies, it just evaporated.
It changes software from a product into a commodity. If the software is just a wrapper around logic that an AI can generate on the fly, then the value shifts completely.
The value isn't the code anymore. It's the data you feed the AI or the hardware it runs on.
Which brings us back to the bulls. You have people like Jensen Huang at NVIDIA, Rene Haas at ARM, saying, hold on, don't panic.
Their argument is that this is a reset, not a death spiral, right? That AI will augment software, not just replace it.
It's the classic Jevons paradox argument. As technology gets more efficient, we just find ways to use more of it. Jensen's view is that we'll have billions of AI agents, and they'll still need some kind of digital world to live in.
But even if he's right, that transition is violent. I mean, companies are already shifting their budgets from buying software seats to renting AI compute.
So the money is just moving. It's going from the application layer down to the infrastructure layer. And that infrastructure is physical. It's not just code in the cloud, it's chips and factories.
Right, which is why, even with this software panic, the hardware build-out is actually accelerating. We just got news from TSMC Taiwan Semiconductor.
Yes, that they're moving ahead with mass production of 3-nanometer chips in Kumamoto, Japan.
That's a $17 billion project.
It is. And just think about the geopolitics of that for a second. Japan is becoming a massive hub for silicon again. Why? Because the demand for AI compute is so incredibly high that the supply chain has to diversify.
It's the old picks and shovels strategy. While the software companies are worrying about their subscriptions, TSMC is out there pouring concrete.
But even that trade, the hardware trade, it isn't a straight lineup. Just look at AMD.
Yeah, they're the main rival to NVIDIA, and their stock tanked 17% this week.
And that was a classic case of high expectations meeting, well, a slightly less high reality. AMD's CEO, Lisa Su, she called 2026 an inflection year, but the guidance just wasn't aggressive enough for the market.
So investors have zero patience right now.
Zero. If you're not showing exponential AI growth today, you get punished. It's not enough to be good. You have to be explosive.
And then you get to the physical application of all these chips, which is autonomous vehicles. And this was a brutal week for the robotaxi sector.
Oh, yeah.
We had Senate hearings grilling both Tesla and Waymo.
The scrutiny is really heating up. With Tesla, the senators were drilling down on the lack of LiDAR and geofencing. It was all about safety.
And with Waymo, it was more geopolitical, right? Concerns about Chinese-made vehicles collecting data on American streets.
It feels like we're hitting the regulatory wall. The tech is just moving so much faster than the laws, and Washington is trying to pump the brakes.
That's the friction point. You can vibe code an app in an hour, but you can't just put a robotaxi on the street without dealing with the Senate. The physical world has friction that the digital world just doesn't.
Speaking of friction and big personalities, maybe we should pivot from the tech infrastructure to the people who are trying to control the narrative. The media landscape is going through its own version of this great displacement.
It really is. And the biggest headline there, I think, is finally getting some resolution at Disney.
The succession drama is over.
It's over. Josh D'Amaro is the new CEO, effective mid-March.
And that is such a telling choice. D'Amaro was the head of Parks and Experiences. For so long, the whole narrative was that Disney had to become a tech company, a Netflix competitor.
But by picking the Parks guy, the board is saying something very specific, aren't they?
They're saying they're betting on the one thing AI can't generate, a physical experience. You can vibe code an app, you can generate a cartoon, but you cannot generate a trip to Disney World.
Exactly. The experience economy is the hedge against the AI economy. Bob Iger is moving to a strategic advisor role, but the torch is being passed to the guy who runs the physical empire, not the streaming one.
But while Disney is pivoting, other legacy media outlets are just cutting.
We saw Jeff Bezos slash a third of the staff at the Washington Post and cut the entire sports department.
That was brutal. And it just highlights the crisis in ad-supported journalism. I mean, Bezos has the deepest pockets imaginable, but even he has clearly decided that the old model of a broad catch-all newspaper just doesn't work financially anymore.
Yeah, and there's been a lot of noise about whether this was political. People speculating he's clearing house to avoid conflict with the administration.
There's always that speculation. But I think the business reality is the primary driver here. When you look at the WAPO cuts right next to the Disney pivot, the theme is retrenchment.
The old models are bleeding.
They're bleeding, and these companies are just desperately trying to find a format that can survive 2026.
And it's not just internal cutting. It's external consolidation. We saw senators grilling Netflix this week about their attempt to acquire Warner Bros., Discovery Studios, and HBO Max.
This is a huge deal that kind of flew under the radar for some people. Netflix trying to buy the HBO library is basically the ultimate consolidation move.
And the senators are worried about pricing power.
Of course, if Netflix controls its own end, this is critically important for anyone with a 401k. We have Senator Tom Tillis vowing to block Kevin Warsh's nomination for Fed chair. On the other side, you have Elizabeth Warren warning that the Fed's independence is being dismantled.
And Treasury Secretary Scott Bessent added fuel to that fire, implying the president would decide on DOJ probes into the Fed. So why should our listeners care about all this political theater?
Because markets are allergic to uncertainty. The whole reason the US dollar is the world's reserve currency, the reason US treasuries are considered safe, is because the market believes the Fed makes decisions based on data, not politics.
So if that belief starts to crumble,
If it's JP Morgan or BlackRock starts to believe that interest rates are being set to help a political campaign instead of managing inflation, the risk premium on everything goes up.
which means borrowing costs go up, mortgage rates go up, and that Capex shock we talked about at the top becomes a whole lot harder to finance.
Exactly.
Yeah.
It just adds a layer of volatility to an already fragile system.
Okay, let's bring this down from the high towers of finance to the checkout aisle, because the great displacement is showing up in what we eat and how we manage our health.
The Ozempic and Wegovy wars.
Yeah. We saw Eli Lilly's stock jump because their guidance for 2026 is strong. But Novo Nordisk, who makes Ozempic, they actually stumbled.
And the reason appears to be a $49 pill from Hims and Hers.
This is such a fascinating story. It's a loophole that has just blown the market wide open. So Hims & Hers is a telehealth platform, and they announced they're selling a compounded oral semaglutide.
Let's explain compounded, because this isn't the brand name drug coming off a factory line.
Right. Compounding pharmacies, they essentially mix the active ingredients themselves. It's legal, mostly because there's been a shortage of the brand name drugs.
But Hims is offering this for $49. The brand name stuff can cost over $1,000 a month if you don't have insurance.
It's a massive price gap. It's democratization through a regulatory loophole.
And Novo Nordisk is furious. They are suing, claiming these compounded versions aren't safe or identical. But the genie is out of the bottle now. Consumers are seeing that price tag, and they are switching.
It's the same pattern we saw with software, isn't it? A cheaper, more accessible alternative comes in and just undercuts the expensive, established player.
Yes. The moat of the patent is being breached by the compounding pharmacies.
And speaking of old habits dying, I have to mention a piece of news that hit me right in the childhood. Minute Maid is discontinuing frozen juice concentrates.
The little cardboard tubes in the freezer aisle.
The frozen sludge. I remember hacking away at that with a spoon to make juice. Coca-Cola finally killed it after 80 years.
It seems trivial, but it aligns perfectly with what we're seeing at Yum! Brands, too. They're closing about 250 Pizza Hut locations.
Mostly the old-school dining rooms, the red roof ones.
The red roof era is officially over. The consumer shift is just undeniable. We don't want frozen and processed that takes time to prepare, and we don't want to sit down in a fast food restaurant.
We want fresh, and we want it now.
It's efficiency and quality displacing nostalgia. Just like fresh juice displaced the frozen concentrate, the fast casual model is displacing the sit-down Pizza Hut.
And just like the AI agent is displacing the software seat, it is all the same trend. The old way, which was usually slower, more expensive, or less convenient, is just being ruthlessly pruned.
Even in commodities, you're seeing this shakeout. Bitcoin took a massive hit. It dropped below $70,000.
That's down 44% from its peak.
That is a harsh correction. It really challenges the narrative that Bitcoin is a store of value that's completely uncorrelated to the stock market. And even gold and silver are diverging. Banks like UBS are warning that silver lacks liquidity right now.
So in a panic, people want the most proven, most liquid assets. They're dumping the speculative stuff.
That's it.
So let's try to tie all of these threads together. We started with this $200 billion bet on AI infrastructure. We've seen software stocks crashing because their business model might be obsolete. We see Disney pivoting to physical experiences, newspapers cutting staff, and a $49 drug disrupting big pharma.
If you zoom out, the picture is pretty clear. We are in a violent transition phase. The economy is shedding its skin. The infrastructure of the new world, the data centers, the chips, the AI models, it's costing trillions to build, and that bill is coming due right now. That is the Capex shock.
And at the same time, the old world, the subscription seats, the frozen juice, the cable bundles, it's just getting deleted because it's not efficient enough to survive this transition.
We are in the messy middle. And for you listening, this brings us back to the most critical question that was raised by that CNBC vibe coding demo.
That really is the thought that sticks with you. If a TV anchor can replicate a multi-million-dollar software platform in an hour just by talking to an AI,
then you have to look at your own career, your own job, and ask a tough question. Is my work embedded, or is it a wrapper?
okay, break that down. What's the difference?
Embedded work is like the chip manufacturing in Japan or the Disney park operations. It interacts with the physical world, or it requires complex, high-stakes human judgment. Wrapper work is just processing information. It's taking data from column A and moving it to column B.
Which is exactly what these new AI agents are designed to do.
Exactly. If your job is just a wrapper around information, the AI can strip that wrapper away in seconds. But if your work is embedded in reality or in deep strategic judgment, you have a moat.
That is a heavy, but I think a very necessary question to leave everyone with. The ground is shifting under our feet, and you want to make sure you're standing on the solid parts.
It's better to be prepared than to be surprised.
Absolutely. We hope this deep dive helped you connect some of the dots between the server farms and the pharmacy aisle. There is a lot happening, and we'll keep tracking it for you. Thanks for listening, and we'll catch you in the next one.